Hello, everyone, and welcome back to the PetroNerds podcast. This is episode 110 of the PetroNerds podcast. My name is Trisha Curtis. I am the CEO of PetroNerds and the host of the PetroNerds podcast. And today is June 19th, 2024. It is Wednesday. It is a beautiful afternoon in Denver, Colorado. And boy, do we have a lot of ground to cover in the market today. So I'm going to try to make this short and sweet if possible and really talk about a few big themes today. And that is the health of the U.S. consumer and the inflation in the Fed. And I really want to talk about this recession, non-recession. And I am calling it that because I think that you're getting a slug of data from both an oil price standpoint and a retail sales standpoint and the health of the consumer. And there's a massive amount of misinformation. So the reason I'm doing this podcast today and the way I'm doing it and talking about the health of the U.S. consumer, the recession, non-recession, talking about inflation in the Fed, and talking about oil prices and the macro is really because of all these things. If you're listening to the stock market or you're following the news, there's a lot of confusion. Is the economy okay? Is the U.S. consumer okay? And what does it mean for oil prices? And we're sitting at 81.47 right now, but are oil prices healthy? Are we not healthy? Are we going up? Are we going down? And I want to break down some of that. So it is Wednesday, June 19, 2024. The stock market is closed today because of it's technically a holiday, and which is great for me because I am completely underwater with a gazillion deliverables. I am headed to Boston tomorrow for the American Association of Petroleum Landmen. Yes, they still call it petroleum. It's AAPL. It is their big, I think, annual event in Boston. I am keynoting the lunch talk on Friday, so really pumped about that. That's going to be on June 21st. We also at the Common Sense Institute. Now I'm an energy fellow here in Denver. We have a report coming out on the energy competitiveness index that Colorado has, or Colorado's energy competitiveness, which will be coming out in the next few weeks. So busy with that and pumped about that as well. And then I'm heading to DC next week, where I will be attending the Real Clear Energy event. It's sort of a kickoff event where Mark Mills is co-chairing that event. He is the head of the National Center for Energy Analytics, which I've also joined as a senior fellow. Chris Wright and several others will be speaking there. So that's going to be a blast. And I'll be in DC for that and for meetings. But with that, I think it is really, really important to talk about the state of the economy, talk about the Fed, talk about inflation, because right now we're sitting at 81.47 for oil. That's a very, very healthy oil price, if not too high. And the Biden administration has said as much. It is 85.27 for Brent. And keep in mind, we've seen a lot of volatility. So we've seen a drop down into the 70s. We're back up above 80s. I mean, and I say that with put a little color into that of volatility. We're talking volatility of $5 to $7 swings here, but we have dipped well into the lower 70s, and now we're back up above 80. So there is some volatility in there, and I think we need to be careful of unpacking. Thinking about what's driving prices up. Where's the ceiling? Where's the floor? Is there a ceiling? Is there a floor? And what's going on? And there are a lot of things at play, which we'll unpack after we talk about inflation, the Fed, and this recession, non-recession, I think, that's taking place in the U.S. And why that really does matter for oil prices. Right now, though, continue with the timestamp. It is $2.92 for Henry Hub. That has seen a really healthy move up, way better than we were at that sub $2, a buck and change, where we were seeing negative Waha Permian Basin gas prices. We've also seen the Mountain Valley Pipeline, which is approved and is supposedly is moving gas out of the Marcellus. So that's very helpful. In addition to, we have seen if you're looking at the monthly data, in the March data, we are actually down to 125 billion cubic feet per day gross withdrawals. That's helpful in the context that we were at 129 billion cubic feet per day, so we're at 125. If you're looking at storage levels, we're still really, really high, but a little bit helps, and we're seeing obviously that a little bit of that, the pipeline and a lot of different things helping on the gas side. Also, so Dutch TTF, we are edging up on Dutch TTF as well. That is European natural gas prices. You're looking at almost $11, $10.94 for Dutch TTF. So you're going to see a little bit of pressure there. That can put pressure on inflation in the European economies, which we're seeing inflation really come down, but it's inflation coming down for not the reasons you want, and that's because they really do have a slowing economy within Europe. that also does not bode well for demand for oil prices, demand for oil and oil prices. And then the 10-year yield, we've seen that really come off a cliff. You're seeing the reasons why really yesterday. So we're seeing it 4.219% for the U.S. 10-year yield. I talk about this a lot. I'll be talking about this in my keynote presentation tomorrow or in a couple days with AAPL and going into deep dives with clients. When you look at that chart, when you're putting the 10-year yield and you're putting it with WTI, you do see that really track in line, especially now that we produce so much crude oil. And it makes sense, right, that the 10-year yield tracks in line with oil because it's on these moves with the economy. But 4.219%, that also tracks very close in line with the 30-year mortgage. So if you see a drop down or tick down in the 10-year yield, you're going to see a little bit of a tick down in 30-year mortgages. Not really meaningful given that 30-year mortgage, if it was above 7%, it's really hard for people to buy a house. Is it 6.95%? Still hard for people to buy a house. You're going to have a meaningful drop down. Now, if you get closer to 6% on mortgages, and then you see KB Homes or Lennar or all these groups, and they're buying down points and they're helping folks get in at a 5% or even a little lower, that's when you could see an uptick. But then you have this whole problem where you're leading to more inflation because you're not going to see a drop in housing prices. But that 10-year yield, the reason and the note, if you're looking at CNBC or Bloomberg and you're just looking for it, you'll see that really it's a part of that coming down is kind of from retail sales yesterday, or the data that came in from retail sales. Now, that a lot of this data is about as clear as mud, and I think that's problem. The problem is that if you are listening to Bloomberg Surveillance in the morning or Squawk Box or Squawk Pod, if you're listening to all the stuff or bond sales and all this data, what you hear from analysts is that the data is very, very cloudy, and that's post-COVID. You hear this on the oil side. A lot of people on the oil side have simply given up on really understanding what's going on within the economy and folding that into oil prices because there's a lot of moving parts that are impacting oil prices, and there are a lot of moving parts in the economy. Super, super serious for understanding the health of the economy, the health of the U.S. consumer, and really why this inflation in the Fed matters. And that's where I'm going to start here. And we will come back to retail sales and what's going on there because we're going to be talking about the consumer. But so last week we had the 2-day meeting for the Federal Reserve, and that correlated, and it doesn't happen all the time, but it actually correlated perfectly with the CPI print, with the inflation print and read that came out last Wednesday. So you had that come out in the morning, and then you had the Fed speak in the afternoon. Now, we had the inflation read come out. It was 3.3%. It was sort of bang in line with market expectations. If it was going to be just think about this. If it was going to be 3.4%, the market would have freaked out. If it was 3.2%, the market would have gone gangbusters. The market kind of went gangbusters anyway. They read it a signal really, really well. If you actually look at the data, it's not good. And it's not good at all. You actually have things like electricity prices, which are up to 5.9% on a month-over-month inflation read. So now things are really, really sticky in there. You're still well over 5% for shelter, well over 5% for services. And if you listen to the Fed, that's what you actually heard. And I've talked about this before. The last time the Fed was on, Jerome Powell spoke. I did a podcast on that as well. And I think it's really important to talk about this because the Fed is talking about being so data driven and so data dependent that they're reflexing and moving based upon one inflation rate. Now, they weren't exactly flexing and giving you their answers on this inflation rate because they just got it. But they talk about, as Jerome Powell says, the totality of the data. And he said, we did get the number, we took that into account, but it didn't change anything. And so what really moved the market, and I think this is really confusing, is because you have a few stocks really moving the market. That's NVIDIA, going gangbusters. But you have a lot of concern, I think, in the rest of the underlying stock market and therefore the underlying economy as well, as what could move things higher. And there's big question marks there of what could actually move things higher. So one of the things that moved the market, and one of the many things that's a little confusing, is the dot plot. So the dot plot is basically where all the folks in the Fed are putting their dots, or where they're putting rate expectations, and it's changed a lot. So if you remember at the beginning of this year, the stock market just ridiculously priced in 7 rate cuts, which was insane. That was never going to happen. The stock market was going crazy. And that was because, though, Jerome Powell came out and was signaling to the market at the end of last year, we're going to be ready for rate cuts because inflation's coming down. He shouldn't have done that. He is a dove. He's overly dovish. Janet Yellen is a dove. He learned from her. He's overly dovish. And the problem is that's gotten him into trouble because he's been dovish and he's been signaling. And so the market carried away with that. And then the reality is the inflation data came in too hot over the not this last print, which I think is still too hot, but the previous prints before that all came in hot. And so you had January, February, March, or several months of the hot inflation data, hotter than expected. And so they had to change their tune. And so in April, you saw Jerome Powell finally change his tune and say, on when he was speaking with some other folks, which I've talked about it with the Canadian Federal Reserve, he was talking about, hey, we're gonna have to curb inflation. And so the problem is that you hear in the stock market, people worried about Fed rate hikes. I mean, you have to know this Fed, they were never going to hike rates. They should have, though. And they really should have, one, hiked rates a lot earlier. They should have been hiking rates in 2021, and they should have hiked them higher. Because if you're actually looking at this data, and I don't know why the Fed can't admit this, or anyone in the stock market can't put a chart of this, because I show this in my presentations. I do deep dives and drill downs for clients. But if you chart inflation, unemployment, oil prices, and the federal and interest rates, you will see very, very clear correlations, just clearly between interest rates from the Fed, so the Fed Reserve interest rate, and inflation. When they stopped raising rates, you have a flat line, and you have the same thing for inflation. So inflation stopped going down when interest rates stopped going up. Very, very clear correlation. And you see that within the US economy. And the really bad part of this is that you have Federal Reserve folks coming on TV and saying and taking credit for, as like, basically the stock market is saying that good data or bad data is good data, and that's why the 10-year yield is going down, is because, hey, we got a weaker retail sales, and that means the consumer slowing down, and that means that the Fed work is doing it. Well, I have a news flash for you all. The consumer is not spending less because interest rates are high. It is not because when they are going to the bank, getting out a loan, and then going and spending their money. Consumers spend on how much money they're making. So, and this is where I'm going to get into this data a little bit and talk about this, but we have unemployment rate ticking up a little bit, but overwhelmingly, everybody's employed. The problem is, in this Biden administration and this economy, and but the Biden team is really struggling with this. This is why this is so important to talk about, is they are not winning the narrative war on the economy. So the consumer sentiment index is down, the retail sales are down, from Lululemon to McDonald's, the retailers are complaining that they are losing the consumer. And that's because the consumer is finally pushing back on higher prices. And the reason they're pushing back on higher prices is because they don't have the money, right? Inflation has tapped them out. It is not high interest rates that have tapped out the US consumer. It is persistent and sticky inflation. And that's so important for listeners to understand. It's so important for the folks on the stock market to understand, and folks trading, and anybody in the economy has to realize that this inflation, it's an economy killer. It's a consumer killer. And it's so damn important because I've talked about this before, but typically, I mean, the consumer does not lead a recession, right? It wasn't the consumer that led the recession in 2008. And not every recession comes from a crisis. So everybody's looking at this, and they've been looking for that one shoe to drop, or that black swan to come out, and then to be a big crisis. That can absolutely happen. We have a ton of black swans in the water. I would argue we have way more black swans than we do white swans circling around the water. And we have straws that'll break the camel's back, and there's all these things. But it's not going to be one thing. It's a myriad of things. It's so many damn things that can come together that can actually break the straw that breaks the camel's back. And this weight on the consumer is really, really significant. So you've got a declining, a weakening consumer, and you see that, and it's coalescing. And you can look at actually oil demand and see this in diesel demand as well. Gasoline demand is softening, right? It's not declining. It's just not rising, and it's come off that peak that we had post COVID, that everybody ripped, and the economy opened up, and everybody started driving, and we were ripping. And you saw that along with the whole economy, right? Is that when you wrote checks to people and you sent it in the mail, they literally had mailbox money. People in the oil industry talk about that mailbox money from royalty checks. I would love to be one of those people. I'm not. But you get this mailbox money. That's what came. People literally got money in the mail, and they spent it like crazy. That's what fiscal stimulus was all about. That was keeping the economy going and keeping leisure and hospitality. Now what we have is leisure and hospitality have been where that job growth is. Well, that tends to be the lower income sector, right? That's not necessarily people with college degrees. That's not people making $200,000 a year. And so if you're thinking about when the Biden administration gets on TV and they say, hey, we've added, all these jobs. Well, they haven't really added jobs. They basically got the jobs back that were closed from the economy. So that's one. And so if you're wondering to know why consumer sentiment is down and why the people on the street don't feel the same thing that the TV, the stock market, and the Biden administration are telling them, it's because they don't feel it, right? The jobs came back in leisure and hospitality. And then we have seen wage gains. We're still seeing wage price increases. That's a problem on the inflationary side. On services, when you look at that, it's still above 5%. That's a problem for inflation. It keeps inflationary pressures up. It keeps price pressures up. That is a problem for the Fed. Now, the consumer might think, hey, well, if my wages are growing up, then that's good for me. The problem is, look back 4 years ago or several years ago when you had 3.4% unemployment and you had low inflation, you had around 2% inflation. Everybody was employed and you didn't have high wage prices. You didn't have high prices. So nobody was complaining about inflation. And you weren't needing high wage increases because you didn't have this inflationary problem. If you're getting high wage increases and then you get high prices with it, the wage increases mean nothing. And that is absolutely what we're seeing. So the consumer is now, whether it's Walmart, whether they're trading down. I mean, when Walmart's biggest increase of people that are coming into their stores are coming from people who are making north of $100,000 a year, that is telling you that the US economy is weakening. And so when the actual consumer at Walmart and other stores are trading down, so they're buying, and I'm absolutely one of them. I am if you care about the money that you make, you should be looking to save it. And so you are comparing price. If you go to the store and you're price shopping, you're saying, okay, well, this is a brand item, a store brand item. This is either Neutrogena or this is face stuff, and this is what Walmart's brand is. A lot of people are trading down. I'm absolutely one of them, and that's what you're seeing across the board, is that trade down. So places like TJ Maxx, retailers that are those cost outlet stores, TJ Maxx, all those stores. I don't know all of them. But they are booming because people are looking for deals. And so that's telling you that the consumer, that's telling you about the health of the consumer. So the retail sales data was poorer than expected, and that's why you see the 10-year-old going up, and that's sort of why you see the some highlights in the stock market saying, okay, well, that means that the Fed's going to cut rates. Well, the problem with that, folks, is that if the Fed is cutting rates because you have a weakening consumer, that means you have a weakening consumer. Okay, so the reality is that the Fed keeps telling you, and this is what Jerome Powell, and I'll go back to his meeting, he did not seem very confident. And I've actually met him. I've seen him speak in person. I watch and listen to all of his speeches. And, he's, as I say, he is an eternal dove. He wants to be dovish and he leans that way. He didn't actually sound as dovish, and he didn't actually sound as confident or as agile as he normally does. Because, and I think part of that is because the data is confusing and you have a lot of conflicting data points as all this stuff, this picture I'm painting. And so you have just slightly above 4%. You're ticking up to 4% unemployment, but you still have a pretty healthy unemployment or employment sector overall. It has not fallen off a cliff. And so a lot of folks expected unemployment to tick up way sooner, including the Fed. But that being said, they have unemployment's okay. But the problem with unemployment, and I think you kind of hear this in their voices, or I think you heard this in Jerome Powell's voice, and I may be reading way too much into this, but look, they're looking at all the data. And he always says we're looking at the totality of the data. And the questioning, when he talked in his minutes or when he talked in his briefing is, hey, there's a question, are we sufficiently restrictive? So they believe that at the 5.5 to 5.25% interest rates right now, that they are restrictive. The question is, are they sufficiently restrictive? I'm telling you, within the data, they're not. You're not seeing inflation come down, and they want 2% inflation, and the problem is, even with that, they may have pockets of inflation that are too high that are really pulling down the economy. So the people that are saying the Fed is winning the war on inflation with higher interest rates, it's just not true. The interest rates are not high enough, and the buckets and pockets of inflation are still being maintained. They probably need higher interest rates, but that means more pain to the economy. So if you're thinking about this and you're thinking, okay, well, the Fed is looking at all of this, right? They're not looking at just the CPI print and then saying, okay, well, that's it, and this is what we're saying. So he comes out and he talks, and I don't think he sounded as confident or as agile or anything, and that's because he's looking at the whole economy, and I don't think it looks that great. And so they have a problem that there is a weakening consumer. They don't see unemployment falling off a cliff, but they also don't see inflation coming down rapidly. And they see these sticky buckets in inflation. Now, he can't get out and say, oh my gosh, well, we see the sticky parts of inflation, so we're not going to be lowering rates for a while. And at the same time, we could have unemployment tick up. He can't come out and say that. That would spook the market and everybody would freak out. But that's probably it. And then if you actually see the Fed come out and lower interest rates, that is going to be because we have a really softening economy. And so I think that's important to point out. That's what you're seeing, that's what you're seeing in Europe, right? Is them lowering interest rates, but then holding. And so we have this very unique sort of wait and see holding pattern. In addition to what happened during the Fed meeting was, again, those dot plots. So those dot plots are the folks on the Fed saying their expectations of rate cuts. And that went from, as I said, we were going to cut 7 times, the stock market was baking in, and then we had a lot less dots. And so basically there's a camp where we're either going to cut 2 rates this year or cut once or cut none. And so, and that has changed a lot since the beginning of the year and these inflation prints and these inflation reads. And the Fed probably should not be cutting at all this year because they're probably not going to get inflation down. And even in their inflation expectations, they didn't think they're getting down to 2% this year. So it's actually not until 2026 that the Fed thinks they're getting down to 2%. That's a huge problem, folks. If the Fed is saying, well, we're comfortable with that, we're getting down to 2% over time, they say, and I put that in quotes, over time, that's not okay because the consumer is really feeling the pain. They're already tapped out. And so if you're saying that there's going to be sticky pockets of that inflation for lasting through 2026, that's just complete erosion. And the risk here, folks, is that recession, non-recession, you have 4% unemployment right now. You have a consumer sentiment index, a survey that has really come off a cliff from May to June. You saw consumer sentiment really dive. And this is something that the Biden administration is having a really, really hard time with because they come out and say, well, we added all these jobs and inflation's coming down and it's great. Look at everything we're doing for the economy. The consumer is saying one day in that consumer sentiment survey from the Michigan Consumer Sentiment Survey came in and it had a 10% decline year over year on consumer sentiment and on the current expectations of economic conditions that declined almost 10% as well on a month over month basis. That's huge. So when you actually look at the historical perspective from a current economic conditions, it's exceptionally low. And that means that sort of it kind of tracks in line with the Lululemon retail sales, with McDonald's, with Starbucks, with these quarterly earnings that came out where they said, hey, we're finally seeing the consumer, basically pull back and push back on these prices, and we're just not seeing them in the stores, less foot traffic, less sales, everything. That's corresponding with this data point with the Michigan consumer sentiment. And also with it was that there was an uptick in price expectations. So they actually took the consumer sentiment survey, which is higher income households and medium and lower income households, and it ticked up for the basket for inflation expectations that went above 3%. So the consumer no longer feels confident on the job side. They no longer feel confident on price expectations. They think they're actually going to be a little higher for longer and persistent. And they don't feel confident on just general economic conditions. That's really worrying for the economy. And I think that kind of those data points, I think, at least to me, felt like that's what Jerome Powell's that's what he's struggling with, right? Is that there's a lot of varying data points. You just hear this from absolutely everyone who, when you're studying these charts, and I'm on Fred data, I'm looking at all kinds of data points on oil, on the economy, everything. It's really, really, it's a really mixed basket. But overwhelmingly, and I hate to be the bearer of bad news, overwhelmingly, these data points are not good, especially if you're looking at housing starts, if you're tracking this with oil prices. It looks like we're kind of headlong into a recession. And I would wager we're already in recession. The 50% of people in this country, or everybody in this country that is paying, is on a monthly, is living paycheck to paycheck, biweekly or monthly. And those people are in recession because, one, they don't have that great a job security anymore because as the economy erodes, you will see job cuts. And the problem with job cuts is they happen quickly, right? They happen very, very rapidly. And that is something the Fed is very, very cautious about, and everyone is cautious about, is because once you start having job cuts, then they just cascade. And so when I say the consumer could lead the recession, is that if the consumer continues to weaken, if the consumer to stop spending, if the consumer continues to stop spending or push back or say, I'm not buying that, if you increase that price, I'm not buying it, then you start seeing the company can say, okay, we're going to cut staff, we're going to cut people, and we're going to try to weather the storm. And when you see that, then you start getting, it's really cascading. It happens very quickly and other people copy that, and you just go down this crazy track. So that's the concern. But back to consumer sentiment. So the survey data, we'll get more data as they clean it up because they haven't put the historical in perspective. But from a historical standpoint, it's really, really bad. It's as bad as it was in the height of inflation in 2022. And then really some of these data points are actually worse or around what they were in 2008. So the actual consumer is not feeling great because they still have these very sticky and high prices. And if you look back and you can see, the Fed is looking at, a consumer or price index or the CPI that says 3.3%, but the average person is looking at it and saying, I am paying 40% more at the grocery store than I was in 2019. A book that I bought on Amazon, I just bought my nieces both To Kill a Mockingbird. It is double the price it was for a paperback than it was when I bought it a couple of years ago. Double. So that may be $8 for paperback, it was 4. So when we're talking about it's not 3%, folks. It's way, way more than that. And so when I go to the grocery store, unless I'm a consumer and I'm seeing disinflation, I'm seeing prices really come down, the fact that you still have inflation on top of those already high prices. So that's why 3.3%, and it's way more than, again, it's 5, 6, 7%. If I'm seeing 5, 6, 7% inflation on top of already high prices, I am just beating that consumer down. And so that consumer no longer feels healthy. And so they're pulling back in all these segments. Now, the unemployment side is really, really important, because part of why the consumer does not feel good is because they're concerned now about, I'm spending more. My electricity bills are up. They're definitely up here in Colorado. They're significantly up in Colorado, actually. I just got my bill for the property and escrow tax increase, or the property tax increase and escrow. $300 a month is what I'm paying in addition. That is a massive amount of money. And for a family and people living paycheck to paycheck, that is brutal. And I can tell you it is extremely painful as a small business owner and somebody running my own business. It is, it's painful. I'm not a W-2 employee. So this stuff is not easy to swallow. And this is why you have to really, really step back and realize that if you're hearing the Fed, if you're hearing folks on TV, they do not go to the grocery store themselves. They do not buy their own milk, and they do not feel this pain the same way as the average American. And I think that's truly where you get this disconnect. Washington is in a bubble, New York is in a bubble, and folks just aren't seeing what the average person is actually feeling and what they're paying for things. So then we get this back to this, they don't feel good, and then we come back to the employment side. So you keep hearing about the job gains. And so if you actually go on whitehouse.gov and look at the Biden administration, what they say, they're bragging about the job gains, right? And everything they've done for the consumer and the Inflation Reduction Act, and they show all the spending and how that's helping inflation. Just to put in perspective, tell you folks, if you are spending a lot of money, you are not helping with inflation. And we will come back to that, because that's part of what the Fed is dealing with, is this hangover from COVID. Now, so that consumer, all these jobs being added, those jobs being added, the 11 million jobs that Biden administration is saying they added, those were largely the jobs that were lost when you shut down the economy because of COVID. So you open the economy back up, and largely those jobs that were lost were leisure and hospitality and the food sector and everything else. Jobs that when you can't go to a restaurant, those are not high paying jobs. And even now with wage increases, those price pressures increases, those people are the ones feeling the most pain. So the problem is that the doves in the Fed are hurting the people that these folks that they're probably hurting the most are the people that they say they're supposed to help, which is the lowest income people. And so that's what you're seeing across the board, is that folks aren't feeling good because their electricity prices are up, because their fuel prices are up, because their housing prices are up. It is now way more expensive to own a home than it is to rent, and yet rental prices are up. So everything across the board is up. So there's no way the consumer is going to feel good. And then you have not had the job layoffs, but you're not going to see job layoffs in those sectors that have added in the jobs added. And I'm going to say this, I'm going to say it's not amazing, awesome, high paying jobs. Okay. It is largely leisure and hospitality. And I'm not discrediting that. Those people work their asses off, and I give them massive credit for the folks that are working hard. Okay. And if you have an education, if you don't have an education, working hard is what really matters. But that being said, we're talking about a rip-roaring economy. You want everything growing, right? You want leisure and hospitality growing because high-income people are, demanding leisure and hospitality, and everything's going great. And you don't have that, right? We don't have a rip-roaring economy where tech, you hear NVIDIA and everything, but you actually hear tech layoffs. You don't hear all these major tech companies in Colorado are leaving, declaring bankruptcy, and many of them have declared bankruptcy and left. So you don't have that rip-roaring economy for high wage earning jobs. And I got to tell you, folks, those are what those people spend, and they spend across everything. They spend from restaurants to goods. And something that you heard within the Fed as well in their last week was that they actually saw a little modest uptick in goods inflation. That makes sense to me, because so they were hoping that goods deflation and that goods prices not going up on goods was really going to help. Now, that makes sense to me. That's ticking up is because we still have these attacks within the Red Sea. Now, you don't hear a lot about the wars going on, the multiple wars, the attacks within the Red Sea, and everything going on, because when the news flow is all about Nvidia, or the news flow is all about the stock market or the Fed or CPI or whatever, that's all you hear. And so, you can be forgiven for not knowing that we still have a spate of attacks going on within the Red Sea by the Houthis that are backed by Iran, where the money comes from China. And these Red Sea attacks, though, are really, really meaningful and fold right in line with inflation, because a lot of ships cannot go. About 20% of containers and cargo go through the Red Sea. They no longer can. So they are, unless they're an Iranian ship, unless they are a Chinese ship, unless they are North Korean, unless they are Russian, they're not moving through the Red Sea. Unless they're friends with these bad guys, they're not moving through the Red Sea. So, which Chinese ships are, but it cuts off a lot of days, because now all these ships have to go around the Cape of Good Hope. They have to go around Africa to Europe. So instead of going through the Suez Canal and through that sea, and it's double the time. And so if you're double the time to ship, that's cost, right? That's cost on the containers. That's cost on the fuel. That's increasing on the fuel side. That's part of why we're seeing oil prices up a little bit. And then you're just going to put pressure on these prices, which is probably going to have pushback. And then people aren't going to buy the stuff. So that little uptick we saw in goods prices, to Jerome Powell, is because of that. And so the Fed can't control those things. But the reality is, they didn't raise interest rates enough in the beginning. They didn't cool off inflation enough in the beginning. And now the chicken has come home to roost, and this is what we've got. And we are seeing it in all these data points with a consumer that's not happy because they just don't feel good. And so feeling good is, it's probably one of the biggest things, or at least to be one of the biggest things that would drive, how your pocketbook feels, how your wallet feels the day you're voting, is usually how you vote, and how a lot of people are going to vote, or how a lot of people used to vote. So one of the things that the Biden administration is talking about, and this is really relevant to oil prices, is the Strategic Petroleum Reserve. I have written an op-ed, which it didn't get a lot of, I need to post it on LinkedIn, but I wrote an op-ed with Jason Isaac, who I just had on the podcast, talking about Strategic Petroleum Reserve. And I talked about, this is written a long time ago, about the likelihood that the Biden administration was going to tap it again. So the Biden administration has massively tapped the SPR during when oil prices spiked, and with Russia's invasion of Ukraine. We did not have enough crude oil. We have plenty of crude oil on the market, but we have these high prices for all these reasons, which I'll get into in a little bit more on the macro. So, but the Biden administration, Amos Hutchinson, with the Biden administration, essentially, he told the Financial Times that oil prices are too high. They're too high for the U.S. consumer, and that they were willing to tap the Strategic Petroleum Reserve in order to lower them. So expect prices to come down. And I mean, there can be a lot of messiness with that, because there's a lot of things holding up oil prices on the geopolitical front, but there's a lot of things that can pull prices down. And the Biden administration really wanting to get reelected, and tapping the SPR is one of them. They did tap gasoline supplies during the Memorial Day weekend. I don't think that did much, but they were hoping they could make people feel better. So there's a lot of things going on in there, but gasoline prices are one of them. And so you are seeing that across the board. You're seeing refineries run flat out right now. They're running at 95%. So depending on where you're gassing up, it can be, almost 3 or above 3, but oil prices at $82 a barrel, that funnels into gasoline prices, which is just much higher than people have seen in years past, when, we had when you had $50 to $60 oil, and you had 3.4% unemployment, and you had 2% inflation. You didn't have any of these things. So you definitely see that consumer sentiment is partisan, right? So that if you break it out, and Michigan Consumer Sentiment Survey does this, if you break it out, you do see that Democrats say the economy is doing better, Republicans say it's doing worse. But when you break it out actually across all of consumer sentiment, you're getting the same answer, is that people just don't feel good. And because they, if they're being honest with them, they just don't feel good about the economy. And that's the reality of where we're at. Okay, so now I want to push this back a little bit, that reality, because I want to give I want to give credit where credit is due. So you are really seeing this from. You're really seeing the Biden administration struggle with the story, right? And I talk about this struggling with the narrative of the health of the consumer. So you see this on the website. I say, just encourage you to go to whitehouse.gov and you can look at it. If you're listening to the White House press secretary, you hear some of this as well. And you hear folks, I'm watching CNBC and I'm watching Bloomberg and I'm looking at Wall Street Journal and Financial Times. And so this is where I'm seeing this, folks from the Biden administration coming out and defending, the health of the U.S. economy. And so I've really wanted to dive into this because I folks are struggling with these data points. If the consumer's not feeling healthy, but we've added all these jobs and we have 4% unemployment, why do people not feel good? largely what I'm pointing out is that very, very sticky and high and persistent inflation. That's why. But I call this the recession, non-recession. And that's because, the people don't feel good. They're living paycheck to paycheck. But then I want to talk about these job gains. And this is hard to talk about, but it's real. And I was listening to Bloomberg surveillance the other morning, and they were talking about the things that we face in the oil market, which is how hard it is since post-COVID to actually look at the data and get an answer of what's going on and really see the data and say, okay, this is because demand's declining because of this, or it's electric vehicles. We'll get in that to a second, because the International Energy Agency thinks that demand is declining largely because of electric vehicles, and it's actually not. It's really the economy. But that being said, so this woman's talking about the job market, and she's saying, okay, well, so we have added all these jobs, and so we've talked about immigration and immigrants coming into the U.S. This has become a hot button issue. It's a politically hot button issue. It's a bipartisan issue, and that's because you can have an influx of migrants, and part of that is good for the U.S. economy in that it is adding to GDP growth. So you can say just headline GDP. Immigrants coming into the U.S., they're coming into the workforce, adding GDP. Now, some of this is on the table, as in they're getting paid and they're paying taxes on that. And some of it is under the table, where this is, people they're not declaring their income, so they're not paying taxes on this. Now, there's definitely an inflationary aspect to this, because if you have 10,000 immigrants coming in a day or a week or whatever it is, you have thousands of immigrants coming in. And whether it's Fed or Bloomberg or anyone, all of them say it's way, way higher. Even Jerome Powell has said multiple times, it's so much higher than they thought. The data of how many immigrants are coming in each day is so much higher than they thought. So that's how he was trying to figure out, Jerome Powell and the Fed were trying to figure out why we have higher than expected GDP, was part of the immigration, right? Is that you just had so many people coming in. So those are job additions. But the reality is, so many of these job additions that the Biden administration is talking about are not going to U.S. citizens. And I'm not ripping on this because they're saying it's U.S. citizens versus immigrants. I'm saying that when you're adding this job data, and a lot of those jobs are in the labor sector, are in leisure, hospitality, and labor and construction. Those are going to, one is saying that a lot of Americans aren't willing to do it. And so these immigrants are coming in and they're willing to do the work. So that is adding to GDP. But it's part of the reason why you're not seeing, why the Biden administration, when they're saying, why isn't the consumer getting this? Why aren't they feeling good? That's part of it, because they're not the ones taking those jobs. And that's because there's lots of different reasons of why people have come out of the workforce, and aging economy and everything. But if you have folks coming into the U.S. that are not citizens, that are getting those jobs, that's not necessarily you're not going to get that in strong data points for the health of the U.S. consumer. And that also means that's why we have wonky data in a wonky economy, is that you have rising, you have inflation, you have immigration, and you have the immigration being positive for folks being able to hire people. They're able to hire businesses. You hear leisure and hospitality, you hear hotels talk about, how important it is for them to have a stable immigration flow, so they can have folks that are willing to work in these sectors, and they can keep that up, and that helps them with wage inflation. So there's a push and pull on all of that. But there is a reality that when you have all these folks coming into the US, no matter what, you're going to need housing. So for every person coming into the US, you're going to need housing. And it would be silly to say that we don't have pressure on housing inflation because of immigration if immigration is up. That's just a reality. That's going to be, no matter what, you are going to have to house people, and you're going to have to feed people. So if I took all of the state of Wyoming and I moved that entire state, which is 500,000 people, but I moved it into another state, I'm going to have I'm going to have all kinds of pressure, from inflation on housing to food, within that state, because I've added all those people. That is no different than if we have folks that are looking for a better life in Mexico coming up to America and they're getting jobs. You're going to have, if you have more people coming in than you normally do, and we certainly have more people than we normally do, based upon the rules, that's just a reality. So it's a push and pull. It's positive. It can be positive for headline GDP. It can be good for that, but it's a reason why the Fed is having a hard time with its data. And I do think it is a reason also why we're not seeing that come out in consumer sentiment, why things aren't so great, is because the jobs being added are on the labor, construction, leisure, hospitality. They're on those sides. And I would say, I don't think we're going to see strong growth on the construction side. I really don't. I don't think we're going to see strong demand on that side, because that's something that's going to falter. And if you're looking at the housing data, if you're looking at construction data, not construction data, sorry, but if you're just looking at housing starts data, that's really wonky too. It's not a perfect line or correlation that, pre 2008 recession, we were actually coming off a cliff for housing starts way before we actually hit the crises. We don't see that perfectly. We see where we've come off, and then it's kind of jagged and messy. But I don't think it's going to, interest rates would have to be much lower and you would have to have a rip-roaring economy. And the problem is that when we lower interest rates, we're not necessarily going to incentivize people. If we're lowering interest rates significantly, it's probably because the economy is declining. And so I think we're in a wonky territory. That all being said, is that as long as people have jobs, if we also lower interest rates, there are a lot of people that are going to want to buy homes. That's going to be inflationary and keep housing prices up. So that's not going to help on the housing inflation side. So that's one of the many, many things that the Fed is dealing with, and a lot of very hard and wonky data points to deal with. There's a lot of complexity out there for why things are up, why things are down, why the consumer doesn't feel good. But I just want to end this segment with saying I absolutely believe that a vast majority, the good chunk of Americans living paycheck to paycheck, are already in recession. And if there is the straw that breaks the camel's back on starting to where people are starting to cut jobs, that's where we start seeing the real pain, and that can be a problem. So with that, though, I want to pivot and just talk a little bit about oil prices and risk and the macro and these drivers for oil prices. And the reason I think that's so important to talk about right now is because I hear it from clients. I'm spending, I'm building 200 slides and decks to talk about the macro with clients of what are the push and pull factors on oil prices. You actually just had Vladimir Putin, the president of Russia, go visit North Korea and sort of reaffirm this relationship with North Korea. This is the second time he visited. We saw the delegation and Kim Jong-un and folks from North Korea actually visit Russia just several months ago. That partnership and that reaffirmation of the relationship, it's pretty serious given that North Korea and Russia are both nuclear powers. North Korea has been sanctioned for a very, very long time, heavily under sanctioned with just a horrible economy. But it's very interesting to think about the state of that economy. Like, it still muddles through, right? The people suffer and everything, but it still muddles through. The Russian economy has also done actually really, really well despite all these sanctions. And I say really, really well. It's not an amazing growth story, but it's done much better than people expected because it's a very simple economy. And therefore, it's been pretty resilient within all these sanctions. Now, that Russia-North Korea pact that they're doing, or that sort of signing partnerships and deals and doing stuff, one, it makes the West pretty cautious because you have this new congealing of between Russia, China, Iran, and North Korea, all nuclear powers and all not a fan of the West. And part of the reason why they're congealing in this relationship, or this sort of axis of evil that is put together here with these four powers, is because they are anti-Western and they're anti, the things that are, if it's helping the US, they're pretty much against that. So the big deal, though, with Russia and North Korea is weapons. Now, it is basically because Russia needs ammunition and they need weapons. Now, they're getting a lot of that from China. That is a big problem and sticking point that you heard within the G7 and other things, is that the US and the West have finally woken up and started to say, hey, China, you're supporting Russia. China has been supporting Russia throughout their entire war in Ukraine. They are buying oil from them at over a barrel. I mean, literally, they're buying over 2 million barrels of crude oil from Russia. They're buying a crap ton of natural gas. They're buying coal. They're buying everything. So Russia's getting all this money from China, but China is actually part of the reason why China, I think they're doing so well. And that's so interesting to think about in terms of their economy. Now, I think the Chinese economy is a mess and it's a big problem for oil demand in the oil growth story. However, the Chinese economy is probably on a bit of a war footing for how much they're supporting Russia. So they're giving Russia ammunition, they're giving Russia technology, they're giving Russia weaponry. That means they're making this stuff and they're sending it there. And some of that is driving some oil demand within China, if at the very least just transporting it over there. So that's definitely some war footing support. And I think you're also seeing that within the Russian economy. They have a war footing as well, which is supporting their economy, and they're making this stuff. So if you think about all these guys together, they're collectively doing a lot more than the world really expected them to. So if Russia's going to North Korea, one, that's a sign of desperation, but also that's something that works. North Korea desperately needs they need trading partners. They need a better relationship with Russia. They need oil from Russia. They need food from Russia. They need all kinds of things. And then fold Iran into this. Iran is the one that's funding the Houthis, which are in the Red Sea attacking all these ships, and they're doing it really cheaply, really effectively with drones, with just not a lot of high tech and not a lot of people and not a lot of money. And so you're seeing how effective these things are, how effective these destructive terrorist campaigns are with that are non-state actors, but kind of state actors funded by the states. And the Houthis are one of them. The Houthis Iran has ramped up. You're seeing ramped up stuff with Hezbollah, which is in the north in Lebanon, above Israel, and then Hamas, which Israel's currently fighting within Gaza. All of that, the Houthis, Hamas, Hezbollah, all those H's, those are all funded by Iran and directly funded by Iran. And the way they get away with it is because they say, oh, it's a proxy and it's not, they can't control it. They absolutely can. It's called pulling out the piggy bank. And that's why the Biden administration hasn't done anything on that, because they wanted to loosen sanctions on Iran since the very beginning of the day they walked into office, but they couldn't because all the hardliners in Iran do really bad things, like they're doing right now and funding all these groups. And so, but Iran is selling over 2 million barrels a day to China. And so in turn, at 80 something dollars barrel, that's almost 5 billion a month that they're getting. So that's 5 billion a month that they can go support all these activities. So this is whack-a-mole with major problems that the world is dealing with. So if you wanted to solve this, you would sanction the crude oil going from Iran to China, you would stop that money flow, and then you would actually, the fact that we add sanctions every day, it seems like, on Russia, that there's any sanctions left to add is ridiculous. We should have sanctioned the crap out of them in the very beginning. And now what the G7 is doing is looking to tap frozen assets from Russia and use that for the war effort. That's really tricky on a legal standpoint. It's interesting that we're doing that hasn't been done before, because that means that in the future that could actually be used against the West, that could be used against the US. I'm not saying it's not defending Russia at all, but I think when you're tapping frozen assets, that opens up a Pandora's box, and that can be really complicated. So with that being said, I'm going to spend a lot more time talking about just the state of geopolitics and this complexity we're talking about with this axis of evil, what's going around the world. But if you're summarizing this and you're just thinking, what's the push and pull in oil prices, what's driving it, is that in addition to that, we have all these tensions within the South China Sea, all these things that are this geopolitical angst. Those are all putting basically a floor on oil prices, right? So they're keeping oil prices propped up. How much that is, that geopolitical risk premium, whether it's $10 or $20, that matters, because if we're $82 a barrel and $20 or $15 or $10 is the risk premium, that means that oil prices are actually lower. And when you're looking at so you have this geopolitical risk that will definitely keep prices propped up, but you have the Biden administration talking about wanting to lower prices and releasing more crude oil from the SPR. Well, you've already drained the SPR a lot. So that means that you're kind of actually putting another floor on oil prices, because, somebody will have to fill up the SPR, which means you'll be pulling production from the US. But that being said, you've got 13.2 million barrels a day of crude oil out of production out of the US. That is with 100 less rigs. That's about 600 rigs we have in the US. That's 100 less than we had last year at this time. Baker Hughes, interesting enough, is not producing their, everybody looks at Baker Hughes rig data. Maybe people don't look at it anymore because they don't think the rig data is relevant. It is really relevant. I'm putting out a paper with Oxford Institute for Energy Studies. I'll be doing a lot more work on US shale with the National Center for Energy Analytics. And one great chart, and I'll be showing it in lots of client presentations and in this keynote address, is looking at the rig count chart with just the rig count and lateral length. That lateral length goes up, the rig count comes down. So essentially, you're able to do a lot more with a lot less. But the point is, the U.S. is producing 13.2 million barrels a day. Russia's still producing a crap ton of crude, probably around just under 11 million barrels per day. OPEC revised those figures. They're now taking condensate out of it. So they're saying it's something like 9 million barrels per day. And then Saudi Arabia is producing 9 million barrels per day. So you might look at this and say, okay, well, that means that if Saudi Arabia is producing 9, and then you got all this geopolitical risk, this is very supportive of oil prices. But the problem is that means that Saudi Arabia has at least 3 million barrels a day of spare capacity. We know that Saudi Arabia can produce 12 million barrels a day. They could probably produce more if you ask them. And we know that Russia could actually produce more as well. Might be a little harder for them on a war footing, but the point is that global spare capacity, just OPEC in the Middle East, it's huge. So we have a few million barrels a day of spare capacity, which means that's available for the market. And the fact that the U.S. is producing 13.2 million barrels a day with 100 less rigs than it was before, and is doing a lot more with less, with oil and gas companies, not even talking that much about oil and gas. I think that's reflective in the share price performance. I've said this time and time again. I'll say it again. Oil and gas industry CEOs and leaders and publicly traded companies need to be talking about what they're doing clearly, because folks like me, the reason I have a job and the reason I'm out there talking about this is because no one's explaining all these things impacting oil prices, and why people have to be investing in oil and gas, and why this matters so much. And there's a failure by the oil and gas industry to speak clearly about what they're doing in the business, just so that that information can disseminate throughout the market. So sorry, that's a little tangent and side note, but I think that's really critical. But that all being said, the U.S. is producing a lot of crude oil. Saudi Arabia is still at 9 million barrels per day, and you are $82 a barrel and change, and you have a softening and weakening U.S. consumer, and there's no bright spot in the global economy for growth. Now, the geopolitical risk premium for anything going on with the tensions for within China, Russia, North Korea, and Iran, that can certainly prop up oil prices. If we have to sanction Iran, that will. And I think that's what you're sort of seeing is really, if I'm thinking about how I'm talking to the oil and gas industry and folks outside the oil and gas industry, there is a lot of, there's not a confidence in oil prices right now, right? There's a lot of uncertainty, and that uncertainty is exactly, all the stuff I'm talking about. The health of the economy is not there, but this geopolitical risk is there. And the problem is that geopolitical risk further weighs on the health of the economy as well. So these push and pull drivers are extremely complex. They matter a ton. And with that, I really hope you guys enjoyed this podcast. I can't wait to talk to you again. The next podcast is going to be with Tad True. And Andy Black. It's the with the Liquid Pipeline Association, where we talk all about midstream and we talk about production as well. But it is a phenomenal conversation where they basically asked me a ton of questions. We did a webinar. It was awesome. So that'll be the next podcast that drops. I will be speaking with the Association of Petroleum Landmen, AAPL, in Boston this Friday, and I will also be speaking with the Independent Producers Alliance of New Mexico, Association in New Mexico. The Independent Producer Association of New Mexico, IPA. I will be speaking at that as doing a geopolitical talk as well. I'm really, really pumped about that. That's in Albuquerque. That's in July. So I'll be speaking at that. And then with Common Sense Institute, we will have a paper forthcoming on this Colorado Competitiveness Energy Index, where looking at the rising prices of electricity in Colorado and how that's making Colorado significantly less competitive, especially to nearby states like Wyoming and Utah. And then I'll be in Washington, D.C., and we'll be doing a lot and talking about China and long-term coal use in China and why you're playing whack-a-mole with global CO2 emissions, because as you're trying to drop them in the US, you're curbing coal-fired power generation. You're simply increasing that coal-fired power generation within China. So lots to talk about in future podcasts. Really look forward to you guys tuning in. I am accepting podcast sponsorship. I have a few in the queue right now, so we'll be teeing that up. But if you guys like this content, if you want this content out there, if you want it free, if you want it in the public, if you want it in the domain where the market is dissecting this information and has that information available, then become a podcast sponsor or become a client at PetroNerds. This year has been it's been a great year. I really look forward to working with you, and I'll talk to you soon, folks. Bye.